GM everyone, and welcome to Smart Contact, an interview series with the world's most influential and impactful Web3 leaders. This podcast is produced by Web3 Harbour and is supported by Circle. Like and subscribe for more Smart Contacts.
Welcome to another episode of Smart Contact produced by Web3 Harbour. I'm Tchui, Vice President and Head of APAC Ecosystem for the Hedera Foundation. I'm also your Executive Director for Web3 Harbour. I'm your host today. We are recording this in the live audience. Today's Smart Contact is with Youngro Lee, Managing Director, Head of BitGo Asia, and CEO of BitGo Singapore. Thank you for joining and having this conversation today.
Thank you for having me. It's always exciting to be back in Hong Kong. You mentioned 20 years, 10 years ago, 11 years ago, I was in Hong Kong, and so it brings back memories.
You know, it's a very interesting week as well. We have the Bitcoin conference, right? I assume yourself, your team was there. BitGo has a very long history of being an institutional grade custodial provider. Bitcoin has a very long history of both a retail product, but now becoming an institutional product. So maybe we'll start off with, what are some of the takeaways that you've seen today? And has it triggered anything for you?
I would say less of a trigger, as much of a confirmation of kind of thesis or beliefs I've had, and it's been nurtured over the years. To me, it's fascinating if I look back, because we talk about 20 years and it goes by so quick. But 10 years ago, I was literally a private equity lawyer in Hong Kong. I started my career in New York and US, and let's go way back. I started in 2007, and literally my law firm was representing the Federal Reserve in the Lehman crisis during the Great Recession, for those of you who remember that. And as a fresh-eyed lawyer, young lawyer on Wall Street, I was stunned about what was happening. And that's the origin of Bitcoin, right? The events of that period was literally I would say, in history will show this, the failures of the traditional capital markets in 2007, 8, 9 started this movement called Bitcoin and crypto in general. And fast forward, I guess, from 2007, that's 25 years or so. The fact that there's a conference dedicated specifically to, let's say, Bitcoin, but more broadly the crypto industry, and that it's in Hong Kong, of all places, whereas the original kind of capital markets activity started in New York, just because US is the capital market system. I think that's fascinating. For all the people that are in the industry, whether you're serious or not serious about it, there's a lot of different opinions, I think, about whether this is good or bad or anything in between. Well, you can't deny that it's here. And if something's here and something's out of the Pandora's box, you can't take it back. And so I think it's, for those of you who care about it, the mission, at least to me, is it's out there. People can do good or bad things with it. Let's try to do some good. That's kind of how I look at it.
Obviously, one of the biggest trends in this latter half, or I won't even call it half, but the latter part of the cycle, is digital asset treasury, right? Yep. Trust is a very important thing. And the reason why I bring up trust is because in Hong Kong, to be a custodian, you need a TCSP license, right? And if you take a look at that, and last year's Bitcoin Asia really focused on building a programmable layer on top of Bitcoin, like the Bitcoin ordinal movement. Boy, has it changed, has it moved, right? You actually literally have different countries, different companies getting public money to help build out this really interesting institutional financial product. So question is two parts. One is, what does it mean to BitGo? And the second, obviously, what does it mean to you? And if you could just help our audience and listeners understand a little bit more about the trend and what does it really actually mean as coming from your background as a lawyer as well as the capital markets.
So I'll talk about it in the form of a technical answer to that, and then maybe more of a philosophical general answer. The technical answer to that, digital asset treasury companies, and obviously Bitcoin is the biggest asset that's being covered in that context, with companies like MicroStrategy and MetaPlanet, especially in Asia. To me, it basically is a way for, we said TradFi in the opening headlines, for a traditional financial system, but that also means, let's say, the average individual to access digital assets in a way that they could not do before, right? Degens, as some people utilize the word, the people that have been in this space for a long time, they're very technical, and they were able to find and create new technological tools to access this asset class. For the rest of us, you couldn't. So the fact that now you can have literally your stock portfolio, I don't know what the rules are in Hong Kong, but in the US, the Bitcoin ETFs is literally the fastest growing asset class. But now you can do that in addition to the Bitcoin ETFs. Like there's actually public companies that you can access for even more specific or slightly differentiated exposure to the asset classes. So I think it's just a trend, again, confirmation of the trend that more people, more traditional finance, but by definition, more average, people from a financial sophistication can access now not only Bitcoin, but other kinds of asset classes that are coming up board like Ethereum and whatnot. From a regional perspective, this is also where I think I myself don't know where this world is going to go, but it's definitely starting where different countries are taking a stand and different laws are coming into effect. So historically, if you think about the origin of crypto and just digital assets, it didn't matter where you are. In fact, that was the beauty of it. Some people disagree, but in my opinion, Web2 was largely an American invention, and the battle was won by America, Silicon Valley, right? Like literally, internet was dominated by American companies, and that's why America and Silicon Valley became, this global power force. Web3 was actually not a U.S. invention, right? It was actually a global, more democratic process.
In some ways, Hong Kong, no?
Many ways, Hong Kong. That's the irony. China, Hong Kong, East Asia. This was actually where the technology proliferated and started to grow. Governments didn't do anything or say anything. It just let the world go where it did, and that's why there's been so much backlash, across the industry over the last 10 years or so. Now, countries are getting it because they realize kind of what the first point we said, it's here. Whether you like it or not, it's here. So you got to do something about it. Obviously, US being US has been a big driver of that. So with the new Trump administration that came in, they obviously completely changed the dynamics. Whereas the previous administration was very, I don't even want to say anti as much as although they were anti, it's almost like they refused to believe that it existed and it wished it went away. This administration is the opposite. They're aggressively trying to harness it. And these statements by President Trump and also the US regulatory leaders, they're very blunt about it. They want America to be the capital of crypto. They literally want more people to buy US denominated stablecoins because that means people are buying US dollars. For foreign countries, especially Asia, that's actually a very scary thought. Right? Why would anyone buy your local currency if they can easily, with a click of a button, buy US dollars? And their savings are going to go into US dollars and US treasury bonds and not whatever the local currency is. So I think that the rise of the global digital asset DAT companies, there was some announcement right now in the conference about a Korea-focused company that just rise. And there's companies like that in Japan, obviously, and I think Taiwan, Thailand. To me, this is like day one or first inning of different countries, different regulations, different regulators trying to own it, but hopefully in a positive way, right? Not to discourage it, but recognizing it's here and recognizing they have to do something if they want, frankly, the next 10, 20 years to matter in their traditional financial ecosystem.
So, Asia's always been a great growth market for Web3. It's also been challenging because of the fragmentation.
Yep.
In many ways, the fragmentation allows the opportunities for stablecoins to actually be very successful, whether the U.S. denominated or another, fiat referenced stablecoin. Mm-hmm. But I think one of the things that I did notice, and I'm glad you mentioned Web 2 and potentially your thesis about the U.S. or Silicon Valley has won, because that's the next topic, and I really do want to segue after this one. Going back to the point I was trying to raise. The fragmentation, do you think that's going to continue? Because look, these DATs, right? Each jurisdiction today has rules. Like in Australia, to be able to list on the Australian market, you have to have fundamentally whatever your core business is has to be reflective, or else you can't list a DAT. And in Japan, there's tax implications and structures that prevent that form of listing and arbitrage. So, what do you think? Do you think they're going to buckle down and use this as like a moat creation, or do you think they're going to take a U.S. focused stance and say, okay, let's just make this happen across the region?
Having been working in fintech for 10 years and before that as a lawyer, having worked at a lot of complex like private equity transactions, the analogy that I like to explain is that fintech and blockchain innovations is like a spider web, meaning as a spider starts to, start with nothing, and then, I don't actually know how spiders make spider webs, but I'm just imagining like they're doing crisscross, and by the end, it looks like an amazing art, right? But that's not how it started. And then depending on where you go, for where the spider goes, like you can go anywhere anywhere along that spider web through all the different mazes. That's kind of fintech, because it's a combination of technology, legal considerations, regulatory considerations, like just market trends, culture, all these things combined. And that's the complexity part, I think, for both the entrepreneurs and the companies and institutions and regulators, because you have to have a broad perspective. What I mean by that, as now come back to DAT, is that there's always been local laws. Every country has securities laws. Every country has currency control laws. Every country has whatever laws you're thinking about, some better than others. The difference now versus 10 years ago or 5 years ago is that there was no enforcement. I think when there's no enforcement, mainly because there's no clear way to interpret it, and frankly, the market and the collateral damage wasn't big enough, that no one did anything until obviously the FTX crisis and Luna crisis. Like that's really what changed the movement. That's why the US was at the time so negative about certain things, and then it changed with the administration. I think as a result of US, for better or worse, yes, other countries have to react. Like they literally cannot just stand and watch US, in essence, attract capital, talent, whatever, in a way that's going to negatively hurt their economy. So I do think that local countries, I assume including Hong Kong, will be more active, both in terms of clarity in regulations and candidly enforcement. We kind of see a little bit happening in Singapore. As many of you guys know, Singapore government has released different kind of essentially enforcement actions in the last couple months that has made an impact even in that jurisdiction. The Middle East, Dubai, Abu Dhabi, there's multiple regulators, some with inconsistent or confusing messages. Hong Kong, I know, is trying to do the same. Same with Korea. There's a bunch of laws pending in legislation. So all this, where this all ends, I'm not sure. But what I do know, and this is also where BitGo comes in to answer your previous question, this is not just about technology. So if you just have an amazing technology or the best code, it's not enough. So you do need the legal compliance insights and expertise and, frankly, creativity. And that's the support that we are trying to provide to the ecosystem, that there's no one answer, but there's potential solutions that we can prepare together. We can create not only the technological solutions, but also the legal framework or the legal defenses, candidly, to prepare in case there's a issue later on in the future. And I think if you can combine all those things and if you're proactive about it, there will be a net positive movement, because at the fundamental level, for all the geopolitical reasons I said, I do think every country, they are trying to do more regulation enforcement, but I think in a way they can actually help it grow versus maybe 5 years ago, it was the opposite. They're trying to do that so they can kill the industry. But I think it's different now.
Maybe add a little bit more. I want to double click on that one too, right? When you're saying the BitGo and the approach that BitGo takes is compliance first.
Yep.
So that's for the regulatory and regulated activities for enforcement. I would imagine in a place like Hong Kong, even Singapore, supervisory technologies are extremely important. Like as they plug into not only the blockchains, but the infrastructure, and then also into your core activities and your technology stack. Let's try not to get into the technology stack too much. But I do want to understand how you work with regulators and how is that different in the key markets that you look at?
It's both a very simple and complicated question. That's why lawyers typically make the big bucks, because no matter what, lawyers win, because everyone has to hire lawyers. And I say that as a former lawyer. It depends on the regulator, is the short answer, which is different regulators have different requirements. So for example, in US, one thing that I do respect about US regulators, or at least their philosophical approach, is that it's not as like prescriptive about like, hey, you have to do these like 1 to like 100 different things. It's more of a statement that they make, right? And they are putting an onus on the actors to do things the right way. Because if there is something bad happens, they will come after you, and then you're in deep trouble. But that, I guess, philosophy of regulation, where the law, literally, if you look at the statute of kind of what I did, which is the exemption to private offering rules that allows individuals to invest in private companies, and that's literally what the RWA tokenization, which we'll talk about in a little bit, RWA securities offerings are in fact going to have to follow the exact same securities laws as if you're selling a fund or any other private company securities. You have to basically develop a position and be prepared. You don't have to explain everything up front. You just have to be very confident that you're doing it the right way and you're willing to literally go to the end with that position. So that's a different approach in US. Regulators, not everyone, but in Asia, generally speaking, are actually the opposite approach in my experiences. It's less about here's a general statement, not that we trust you, but like you guys know the laws, know the market, and so do it well or else. they won't even give you a license until you do these 100 different things.
Yeah.
From the entrepreneurship perspective, especially like this is stuff that maybe a tech founder might not think about, but as a lawyer wanting to go into entrepreneurship, maybe that's why I did it, because like that was my edge. Like, because you basically have to make a decision every single time where you follow or not follow from a risk assessment of a legal liability or regulatory liability perspective. But when you're dealing with the Asia regulatory body, what that really means, honestly, is a startup capital is much higher if you actually want to get into a regulated business in Asia, generally speaking, versus US. Because in order to get the specific licenses in whether it's Singapore, Hong Kong, Korea, Japan, you just have to do a lot more. And you guys can make your own assumptions. What does that mean for the entrepreneurship ecosystem? To me, that often can be counterproductive, because what it really does is discourage the innovations that might otherwise come, because they just see the high upfront costs and just they can't do it. Obviously, the flip side of the argument is, of course, you have to worry about these things, investor protection and all this other stuff. But the counter that I have to that as a lawyer and then doing several startups in the space, no one knows, and especially not the regulators of the government, no one knows what will be the actual impact of a regulation. No one knows what the actual true costs are of setting up a business or setting up this license or setting up this product. So if you make it too much, if the regulatory assumption is that I know, so you have to follow these 100 things, you're killing innovation before it even begins. So that's whenever I have the opportunity to talk to, candidly, regulators or politicians, that's what I suggest to them. In the US, I was involved in various different engagement like this with Congress and politicians, regulators. And generally speaking, they do get it. My personal hope is that the Asia regulators, if they do want to kind of grow the industry favorably, as US is doing, I know it's not going to change overnight, but like sometimes you do have to let the market run its course, and just, if it's the case where if someone does bad, punish them hard, but maybe not try to kill the entire market beforehand.
On a lighter note, I wonder if you took stock of how many 6-minute increments you saved by being a lawyer turned entrepreneur in terms of the total cost.
I will say the fact that I had to do 6-minute counting was a big reason I left the legal field. But yeah.
Yeah. I think this is a good switch now, right? So you were lawyer first, and then you became a seasoned entrepreneur, multiple different startups, and I would assume many different experiences from those startups. But you had made a comment earlier. You said that you believe that the U.S. or North America, specifically out of Silicon Valley, did Web2 right. And my question now is, getting into opportunities for entrepreneurs, VCs, and PE activities, is Web3 really different than Web2? And why is it that we haven't seen that many Silicon Valley successful conversions in what would be deemed like a Web3 startup?
Yeah. I mean, I think you're starting to see some of that now with recent trends on a lot of these crypto companies becoming more public. But I think if you ask fundamentally what's the difference, I do think it's because of, and this is frankly the selling point of crypto and blockchain, despite what I just said about the regulatory licenses being expensive and complicated, because it is, the technology itself is actually cheap and it's easy to obtain. From an internet perspective, I'm not a tech engineer, so this is very high level statements. If you wanted to get started, it's especially in the beginning of Web 2, you needed servers, you needed expensive things. And that's only when basically AWS came out and cloud storage came out, that's when more people were able to access internet easier. But I talked to some of my friends back in, again, this is the pre-Facebook days of true entrepreneurship. Whatever money they raised, they spent it basically all on servers and databases. There's none of that in Web3. There's none of that in blockchain. And that's, I think, the attraction is this is the future. You don't need a complicated infrastructure to actually get going, right? You don't need to be having very established bank accounts or whatever, to the extent you're staying purely on-chain. And most importantly, and this is the thing that I strive to get for, I strived in my fintech days, but now also more crypto chase. The holy grail for any transaction is you reduce the number of intermediaries. Fundamentally, that's actually what makes things more expensive. There's good people everywhere, every layer of any transaction. Everyone's trying to do their jobs. But when you add someone else into that chain or supply chain or whatever you want to call it, distribution channel, they all need to get paid. Fundamentally, the value of blockchain is you're moving something of value from one to the other. So the simple analogy that I like to use is internet was powerful because you could move information without friction instantaneously, right? Before I had to like write letters. For those of you guys, I'm dating myself. Like I didn't have cell phone, right? I literally wrote letter to my friends or my parents if I wanted to like talk to them. Whereas now, you send emails, but that was a powerful thing. Now on blockchain, you're not only transferring information, but you're transferring value. Like what we think of as $1, $10, like it's represented by paper, or at least historically it would. Now, like I can click a button and like I can give you whatever I say you assume that $10 because that's like, you just believe it, right? Like you don't actually check the blockchain. You don't actually check Hedera to see like whether something moved. Like you just trust it. So, I mean, this is a very long-winded of saying, I forgot what the original question is, but I think the fact that the startup costs and the true overhead of a blockchain transaction is so much lower than a Web2 industry historically, that this is the potential for, let's say, I don't mean this negatively, but like third world countries or less developed countries to accelerate their growth faster, to not depend on the more advanced countries because they can just literally in many ways skip Web 2 and go to Web 3 entirely. And you are seeing that in parts of Southeast Asia and Africa, for example, from a world like geopolitical perspective.
Sorry to interrupt, but I want to tell you about our smart contract lead sponsor, Circle.
What is Circle?
At Circle, we're building a digital dollar that brings the power of the internet to money.
Circle's the place where crypto meets stability,
where local businesses meet global customers,
and the US dollar meets USDC.
Meet Circle.
Thank you to all of our sponsors and community partners. Now back to the conversation.
I hadn't really thought about all of the original, basically the infrastructure costs of actually setting up a Web2 company, right? But I do agree with you that the talent, the engineering, and basically adoption of open source, and then the proliferation of tools out there, and now even with AI, it makes it even much, much easier. Yeah. I do want to ask you about your VC background, and specifically how that ties into, going back to Web3,
Yep.
dApps, projects, decentralized applications, and projects can self-fund. Yep. They can offer their own tokenomic structures. They can list their token, and then they can custody on Bitcoin, right? Yep. So, I mean, let's actually talk about that for a little bit. So how do you look at, investment opportunities previously, and then how does BitGo actually look at investment opportunities in this space?
The VC world also has been changing dramatically, right? I mean, one thing that's definitely been happening, I think, as a result of the rise of crypto industry is that capital is becoming more commoditized, for sure. And arguably, internet started because there's, when internet companies started, basically a lot more money was created and distributed to individuals who were not the traditional power kingmakers. Now they had, and so a lot of the new VCs and new incubators, new programs that rose out of the success of Web 2, many of them are the initial seed money for the Web 3 industry. And now with Web 3 industry, again, times are changing, but especially in the earlier days, that there was think about it, literally like several, whatever the overall crypto market, is like several trillions of dollars, like that didn't exist. So it just means like several trillions of dollars of real life value was created, being a little facetious, but like out of thin air. And it's distributed in the hands of literally millions of people around the world. So if that much capital is available to a lot of different people, it's their choice, it's their right to spend it on what they want, to invest in what they want. Then to me, the value of a quote unquote investor who's trying to do that for their own jobs or living, like you have to add value more than money. So the way I look at it, I was able to, in my previous jobs, to be able to, start and be part of different VC funds and just making personal investments and things like that. Like the way I think about it personally, and BitGo is not an investment firm, so we don't necessarily invest, cash, but we obviously think of every engagement we do as an investment, right? Where we're supporting a project, we're supporting an entrepreneur, we're supporting institutions, like we're investing in that relationship, we're investing in that potential. It's how do we add value? Right? Like basically what I just shared in my background, like if a company requires some insights or experience or feedback loop on how legal issues oversight or, is related to a technology issue, if it's a geographic issue, experience issue where a Korean company needs to figure out how to do something in US or vice versa. I think that's how I look at it, and that's how BitGo look at it. And I think the best investor in the world has no choice but to look at it as if I can add something more than money. And at the company level, the entrepreneurs, and from a founder perspective, that's what I looked at, is like, I don't care if someone gives me $1 billion if that's all they gave and they just left. Like I need more than the money, because money can get from other places. I need the expertise. I need the support.
So in Hong Kong, you've made support for Riverchain. Riverchain also happens to be a member of Web3 Harbour. Actually, one of the founding members on the board. And wanted to actually talk and ask you a little bit more about the rationale, the RWA play, custody, and just the overall use case itself.
Riverchain is a company that is in the construction financing space, so it's really solving a real life problem of basically subcontractors and contractors where they're getting paid, but they're not going to get paid for like many months. In the meantime, they got to pay the bills, right? So invoice financing, as an example, is a real life world problem. It's worth massive amounts around the world, especially in more disorganized markets and things like that. So the title of this session is TradFi Web3 Convergence. The reason why we from an investment perspective, or I as an investment perspective, look at anything is like nothing to do with Web3. It's just like, are you solving a real life problem? Because I think if you don't do that, if you look at an investment because it's doing something related to blockchain, and you think that is the reason why you should invest, then 9 out of 10, you're going to lose your money. A lot of people, I think of Web3 itself as the reason why you should invest in something. Whereas I think Web3 is just one of many tools that's come along the history of civilization and society, especially in financial markets, where the fundamental issue is the fundamental issue. And the only question is, if you use Web3 technology, can you improve that a little bit, for example, by lowering transaction costs, taking intermediaries out? So the way we look at companies like Riverchain or any other companies, and I think a lot of investors think this way, is if you're solving a real life problem, they're going to want you no matter what. And if you can use new tools like Web3, like AI, that's the delta. That's what makes you potentially even more attractive, because now you can cut costs. Like we talked about how in the Web2 days, in the beginning, you spent a lot of money on servers. After AWS came out, you didn't. And I think that's the power of Web3, because now we think about the future. Like right now, whether it's Riverchain or any other companies, like they might not be leveraging these new technologies, but if we think about RWA tokenization, these are trends and these are issues that are now becoming really popular around the world. And I think especially, Hong Kong, I think, has a specific interest in that as well. When those rules are clarified, when the infrastructure is built, when more people are willing to literally purchase a token and assume that's the same thing as buying the security, now we can think about tokenizing the actual real life asset of, let's say, an invoice financing product or interest on that payment. And you can essentially take out, again, middlemen. You don't need a bank to sit there and tell you how much money it is because you see it on the blockchain. You don't need to have an escrow agent or some other equivalent to verify their transaction happened, because you can use smart contracts. So that's how I look at any Web3 technology, is less about the technology itself, because technology itself changes so fast, but whether that use case can be leveraged to solve an existing problem in a more efficient way.
That's a great explanation of a very, imminent problem, and it's very difficult because TradFi, I can see it's mainly from a risk perspective. It's hard to assess the risk of these projects when they're mid-flight, mezzanine financing. You really don't know what you're getting into, but when the information is now on chain and on spot, you can do a risk assessment to loan or lend or not to lend. I think that's very transformative. That's on the asset leg, yeah? And as we know, with every RWA play, there's an asset and a cash leg for settlement transaction. So yes, maybe on the asset side, it's tokenization of an invoice. On the cash side, it could be fractional payments of those individual workers as they work. So instead of having to wait till the end of the month before they get their salary, they can actually literally get it every minute, every second potentially that they work, right? So if that's one promise of stablecoins, how does the stablecoin narrative now then play into some of the either investments or priorities of BitGo and yourself and your team across this region?
I mean, this is universal, not just BitGo, but literally every single player in the market and every single TradFi market. That's why you see the big giants like Stripe and obviously Circle, but like everyone, like Visa, they're all doing stablecoins. And you actually nailed it. It's the fact that because all the transactions are on blockchain and it's essentially automatically managed, via programs and codes and just smart contracts. Again, you don't need a person to sit there to confirm something because it just happens. If you think about what I said earlier about the value transfer, the blockchain is powerful because you transfer value from point A to point B without there being any trust. In any commercial transaction in real life, like whether it's if you're purchasing real estate, that's probably the biggest use case because you literally see all the people and all the institutions involved just to make that transaction happen. And probably everywhere in the country, you're going to lose from 3 to 10% of your total purchase price to these other entities. And we just accept it because that's just the way it is. But in reality, it's literally like an X% of the total value simply going to people just to make sure that you feel comfortable that this happened. So when you bring in stablecoin to the mix, it's any of those transactions with all those middlemen where if essentially there's some value transfers, I think you're cutting off virtually, if you wanted, unless, again, regulation comes in and requires certain things. Like from a pure technology and security perspective, it is making every transaction efficient. And even more importantly, it is making small transactions efficient. My first couple startups, the startups I did before I joined BitGo, was in the investment space and in the investments in the alternative space, right? Like if you look at the private markets and the public markets, there's also a difference. But frankly, even in the public markets, even when I started my work career, again, in 2007, I still had to pay, I think, $9.95 per trade if I go to online brokerage. Now it's free. So the kids coming up now, like for entering the stock market, I don't think they can understand why this ever costs money because it's free. If you go to Robinhood, it's more than free. They sometimes give you back money. And so those are all transactions that happen in the public market trading space, public market investment to lower the transaction cost. So now effectively people think it's a free service. Obviously money is being made in different ways. In the private markets, and this is squarely where the RWA tokenization market is going because that is not a public security, right? DATs are public securities because they're public listed and they go through the IPO process to get there. But traditional RWA, like the way people are thinking about RWA asset, it's literally going to have to follow the private securities exemptions rules or registration rules. So from that perspective, you have to take out as much middleman as possible if you want to make the dream of tokenization happen, which is not that I have this $100 million property and sell it to 10 billionaire families, because that's actually what happens in real life. Like we can't get in this other building for $100. And the reason why we can't do that, really, when I talk to the founders and these managers of these big institutions that own these assets, it's not that they don't want to sell it to retail investors or not. It's that literally there's no infrastructure. Like what bank is gonna, accept some guy to wire him $10 so that can verify that he received it and give it to the issuer and then so on and so forth. But if you tokenize it so that this $100 million asset can be broken down to 100 million tokens, 1 billion tokens, right? You can program it so you can pay interest on that, as low as 1 cent instead of like waiting for quarterly distributions when the minimum amount goes beyond whatever, $1 million. Like, I mean, the possibilities are limitless, but this is where I think the value prop is there. And this is why I believe there is no doubt in my mind that eventually everything will be tokenized and everything will be sold via tokenization because that's just better. And the opportunity, therefore, is, and this ties to everything that I'm doing, that BitGo's doing, that the entire industry is doing, that's in infrastructure, is like, how do we create that infrastructure layer to enable those transactions to actually happen at scale, at small amounts? And I think that's literally the $1 trillion problem.
Today we've had an amazing conversation, and unfortunately we are almost out of time. So I do want to give the opportunity to close out for maybe the last 2-3 minutes, right? What do you see next for Hong Kong, both from, again, an investments perspective, opportunity investment, when's the next time you're going to be back?
I hope to be back a lot, especially with, I know Web3 Harbour and different organizations are trying very hard to advance the Hong Kong regulatory, structure. And I think the more that happens, the more incentives there will be for entrepreneurs and companies to give it a shot. And if the regulators are very open-minded, they obviously have limits, but I think there is a chance for this to happen. And I think, maybe the real talk, I think the Hong Kong is very, very important because even if people don't want to admit it, China is China. Like you cannot, from a geopolitical perspective, as I mentioned earlier, this industry and this, especially this technology is a bunch of spider webs. If you think about where all this goes over time, there is no way that you can ignore the influence of Chinese population, Chinese government, Chinese influence. Hong Kong, for better or worse, will be the gateway, or is the gateway to China in a way that other cities, including Singapore, cannot be. So I think Hong Kong has a very, very strategic role. It's also a very dangerous role, and that's probably why there's so much concerns around certain issues. But if it can manage those factors, I do think that there will be a chance for Hong Kong to really be a global leader in this space, the way the Hong Kong capital markets really enabled, the Hong Kong we know it to exist, that's based on whatever last 50 years of activity.
Amazing. Welcome. We're going through a very interesting phase right now in Hong Kong with specifically OTC and dealing.
Yep.
And custodians are such an intricate part and vital component of this activity. Welcome more consultations from BitGo and yourself.
We're here to help, we're here to support, and we look forward to working with everyone as well.
Great. Thank you for tuning in to Web3 Harbour Smart Contact Series. We had a great conversation today with Youngro Lee, and we look forward to seeing you next time. Thank you.